Hello and welcome to YCCF's 2024 investment briefing. Thank you for joining us virtually today. First, I just want to share a couple of housekeeping items, including that this session is being recorded. Our participant videos are off, but you will be able to see our presenters. To do so, please switch your screens to speaker view and side by side under the viewing options. That way you can see the presenter, panelists, and slides. Everyone will be muted. And please use the Q&A feature at the bottom of your screen to submit your questions for the various presenters. Questions will be addressed at the end.
Welcome to YCCF's annual investment briefing. I'm Meredith Schruffler, Vice President of Finance and Operations. My team and I work every day ensuring good stewardship of the funds entrusted to the foundation, growing endowment for future generations, and sustaining high caliber customer service. Thank you so much for joining us virtually today to get an update on YCCF's investments and to hear from one of our investment advisors about the impact of the Magnificent Seven on the markets. We're pleased to have representation from both of our investment advisors here today, and they have shared that they are happy to answer any questions you may have about YCCF's investments. But first, to share some exciting updates from YCCF, I'm proud to introduce Natalie Gunderson, YCCF's new president and CEO.
Thank you so much, Meredith, and thank you everyone for joining. I am so excited and thrilled to be leading the amazing team at YCCF. In the few weeks that I've been with the organization, I've already been impressed with how seriously they take their work of creating opportunities for everyone to thrive throughout York County. The highlights I'm about to share demonstrate that commitment. 2023 was a banner year for YCCF. YCCF awarded a record high of $10.6 million in grants to 424 different nonprofit organizations. It's thanks to you, our fund holders, donors, professional advisors, and volunteers that give us the privilege of supporting good work that builds a thriving York County. So thank you. We received $8.5 million in donations in 2023. Our team helped donors start 26 new funds to support the causes they care about for years to come. And nonprofit organizations were able to add $1.6 million to their endowment funds to sustain their organizations forever. Thanks to the generosity of fund holders and donors, past and present, today, people in York County are getting the support they need to thrive. Students from all over York County received more than $525,000 in scholarships to continue their education. Our Racial Equity Fund awarded more than $130,000 in grants to advance equitable opportunities in our community. And we awarded more than $1 million in Thrive grants from our Fund for York County to support economic mobility for our neighbors with low incomes. Thank you again. One of those grants was to New Hope Ministries for their loaner car program. How many of us drove a car to work or are going to drive our car later? Probably all of us. I'm guessing nearly everyone will touch their car or get into their vehicle today. So you know how difficult it can be to get around a large county without a car. The Hope Rides program at New Hope Ministries aims to get people into good paying jobs and start earning a living wage that would qualify them for a loan for a car of their own. If they are unemployed or underemployed, New Hope connects them to their workforce development classes that will land them in a good paying job quickly. Guests borrow the car for 1 month, and New Hope helps them get a loan for their own vehicle so their borrowed vehicle can move on to help another family. We couldn't fund programs like Hope Rides without the foresight of folks like people like you in the room and connected virtually, or without the power of endowment. Philip Woods, our gift planning officer, would actually like to share a wonderful story about the power of endowment and how many of these things are possible. So welcome, Phil.
Thank you, Natalie. Good afternoon, everyone. We're fortunate at YCCF to work with so many incredible donors, and I'd like to mention one in particular. As you know, the York County community recently lost a true advocate and philanthropist in Jody Appel. We'd be remiss if we did not acknowledge the impact Jody had specifically on YCCF. Jody served on the board of directors from 1975 until 1981, again from 1983 until 1989, leading YCCF as president of the board in both 1980 and 1981, during periods of tremendous importance and tremendous growth. Jody believed in the power of the Community Foundation to strategically grant to those areas most critical to the York County community. And that's why she and Louis were among the first to create a fund for York County, a named fund for York County. It is not possible in the short time I have to talk about all the great work and the indelible mark that Jody left on the York County community, but we at YCCF are honored that she chose to continue some of this work through endowed funds at YCCF. Her stewardship of YCCF in those early formative years were crucial to the creation of the YCCF that exists today. She was a trusted and critical community asset who sought to expand opportunities for all in our community. We may never again see the equal of Jody and Louis Appel, but we can all do our part in creating a York County where together we thrive. Please reach out to our team so that we may help you find your place in this work for the York County community we all love. Now I'll turn things over to David Sybil, YCCF's Investment Committee Chair. David.
Thank you, Phil. My name is David Sybil. I'm the chair of the Investment Committee. Thank you very much for joining us today for this presentation. I'd like to start by thanking a few people. The foundation staff for their tireless work in supporting our community every day. Meredith Schiffer and her team on the Finance Committee. The YCCF Investment Committee, each of whom bring a wealth of experience and commitment to oversee the assets of YCCF. And I'd just like to mention their names quickly. Greg Staub, Holly Mayer, Mike Taschuti, Rachel Scapato, Oliver Hoare, Paul Rudy, and Todd Marsteller. I'd like to also recognize a member that came off the committee for her 10 years of service, Nancy Clayhold. Thank you, Nancy, for your commitment to the investment committee over the last decade. She hasn't left the Community Foundation. She's now sharing her experience with our Resource Development Committee. So thank you, Nancy. In 2023, this volunteer group of local experts worked with our two investment advisors, Mason Investment Advisory Services and Commonfund, to continue manage our portfolio. Under the guidance of the two investment consultants, we will continue to seek out investment opportunities that enhance our returns without taking undue risk. Focusing on long-term returns to create a permanent legacy for our donors and provide a perpetual source of revenue for the continued betterment of York County. Our investment objectives reflect why investment returns matter. We want every permanently endowed fund to have the same purchasing power 20, 50, and even 100 years from now. To do so, we must target long-term investment returns that not only cover the annual grant making of 4.5%, which was represented by a little over $10 million in 2023, but also cover fees and the impact of inflation. By using global diversification between stocks, bonds, and alternatives, we can achieve these objectives. Currently, our portfolio consists of 66% equities or stocks. Fixed income or bonds account for 11% of the portfolio, and diversifying strategies such as private investments, real estate investment trusts, and natural resources capture the remaining 23%. By adhering to the risk guidance of the Community Foundation's investment policy and the value of broad diversification, we attempt to minimize volatility while achieving return targets. We are confident that our investment policy will continue to meet the long-term investment returns for years to come. With that, I would like to welcome both of our investment advisors. Mason Investment Advisory Services has been a valued partner of the York Community Foundation for the past decade. They have a listing in Barron's American Top Advisor Rankings, top 20 institutional consultants, a listing in Forbes, as well as a top 50 wealth managers, top 50 wealth managers in Fortune magazine, and a top 50 investment advisors are just a few of their accolades that the industry has honored them with for their service and dedication to their clients. Our second manager, YCCF, began working with Commonfund in 2014. Commonfund is an asset management firm founded in 1971 with a two-part mission. First, to create investment solutions and access to managers and strategies through private capital investments for nonprofits that could not attain this type of investment on their own. And secondly, to create educational programs that could bring current best practices to institutional investors of all sizes and segments, including YCCF. It has been ranked as one of the top 10 most trusted institutional asset managers for nonprofits by Market Strategies International. Bill Corson of Mason Investment Advisory and Kelso Murill from Commonfund are here to tell you more about their expertise, share YCCF's 2023 returns, and introduce our guest speaker. I'll turn it now over to our two managers.
Thanks, Dave. It's an honor to be here today. I want to thank everyone for attending this rescheduled meeting. It's, as I mentioned, it is an honor to be here. The slide that you're looking at now is a little bit about Mason Investment Advisory Services. My name is Bill Corson. I'm a Senior Managing Director with Mason. And one of the things that you might notice is this could be Mason by the numbers. Our most proud number is that line on the top that says that we've been a partner of the Community Foundation since 2010. That one we are particularly proud of. As you look at this slide, upper right, 0 proprietary products. We filter our products that we put into the portfolio based on a open platform. We're not looking at putting our own proprietary products into the portfolios. As you can see, we work with high net worth individuals and institutional clients. Over 50 of those are community foundations all across the country. We work with 46 or work in 46 states across the country, managing over $12 billion. We were founded as a registered investment advisory firm in 1982. So we've been around for a little over 40 years. And we are a research deep organization where our strategies begin with over 7 million data points. And so we apply that data in the development of a number of proprietary processes. It begins with a sustainable withdrawal analysis. As Dave mentioned, we do have a target rate of return that incorporates the distribution fees net of inflation. And we incorporate our asset allocation decision into this proprietary process, hitting that target rate of return utilizing what we call a sustainable withdrawal analysis. We want to make sure that we satisfy the intergenerational equity requirement of investing for today and for tomorrow. And out of that sustainable withdrawal analysis comes our asset allocation strategy, where we determine which are the appropriate asset classes to invest in and what percentages. Within each asset class, we have a proprietary manager selection process, and then we overlay over time portfolio rebalancing, also highly proprietary. So we incorporate all of those processes into an asset allocation decision where we can maintain consistent good returns. We also have the ability to customize portfolios for our clients who are choosing to do that. We have a customizable, socially responsible investing allocation that we can look at individual asset classes where we want to pursue assets or avoid assets. It could be geographic. We even have the ability to avoid individual stocks if that's what our clients are looking for. And we also have access to private equity. So within that customizable portfolio, we are able to apply our proprietary processes and the customized portfolios in order to achieve our target rate of return. In closing, I'd like to once again thank York County Community Foundation for your continued confidence in Mason Investment Advisory Services, and thank everyone else for your attendance today. Thank you very much.
Thanks, Bill. I'll pick up. So my name is Kelso Morrill. I am the Chief Investment Officer of the York County Community Foundation's portfolio as your outsourced CIO or Chief Investment Office. A number of my colleagues are joining today. And importantly, Mark Bennett is our lead portfolio manager for equities. He is going to be our guest speaker in just a moment. So I'll have a couple of comments. I'll keep mine fairly brief so we can get to Mark and his presentation. But Anthony, if you get, there you go. Thank you. So my opening comments are a little bit about Commonfund. As I mentioned, we are the Chief Investment Office for York. We work alongside of Mason as well as some other managers. As Dave mentioned, we have deep expertise in marketables, including fixed income, equities, marketable real assets, hedge funds, but also in the private markets. So private equity, venture, private credit, natural resources, and real estate, et cetera. So when we allocate, we typically allocate to about 4 asset classes, and we've been doing this since the early 70s. Commonfund currently manages about $28 billion for the nonprofit community. And one of the things that we pride ourselves on is that all of our clients in the OCIO program are nonprofits like York. So if we think about where we are, what a difference a year makes, if we remember back to 2022, wasn't that long ago where equities were down minus 18%, depending on how you were allocated. The first number is the global benchmark, minus 18.4. This next one is one you may be more familiar with. The S&P 500 index was down minus 18%. And the Barclays Ag fixed income composite was down minus 13%. If you think about where we are as of the end of 2023, 3 months ago, equities had rallied up over 22% for the global benchmark. The S&P was up over 26%. And the fixed income benchmark, the Barclays Ag, was up 5.5%. Interest rates went on a wild ride, even though on this chart at the end of 2022, the 10-year yield was at 3.9. It was also at 3.9 at the end of 2023, but it wasn't stable during the year. It went up to as high as 5% at one point. Inflation was at 5.7%, down to about 3.9%. And if we think about the York portfolio, it ended 2022 at $169 million. That was a portfolio return of minus 9.8% for that calendar year. 2023, the good news is the portfolio recovered, up 13.2% for the year, ending at about $187 million. If we flash forward to May, that number is about 191. I'm sorry, not May. If we flash forward to the end of February, that number is about $191 million now. Anthony, if we move forward in the interest of time, let's move forward to the peer review slide, and we'll talk about relative performance. This is the York portfolio versus the Council on Foundation Common Fund study of foundations. Dave mentioned that we do some work around best practices in looking at peers. The study of foundations is one of those. Some of you may have seen our endowment study. We do that as well. So as of 12/31/2022, you see the York net return minus 9.8 that I referenced on the previous page. To put that in context of your peers, however, the community foundation peers, 106 other community foundations, their median was minus 13.3. So you outperformed in a down market by about 3.5% for the 1 year. For the 3 year, you can see about 5.7% versus 4.4. And for 5 years, 5.9 versus 4.9. And then 10 year, you're right on that median number. Importantly, if you go down to the bottom there, those returns represent above top quartile relative performance versus your peers for all 3 of those periods, 1, 3, and 5 years. And we're quite proud of that. So that is the good news, I think, in terms of relative performance. But I do want to get to our guest speaker. And so I'm going to introduce now Mark Bennett, ask him to join. And he's going to talk about the state of the market for 2023 and what went on under the hood with the S&P 500 index.
Thank you, Kelso. Yeah, the focus of today is going to be specifically on the S&P 500. And as Kelso mentioned, there's been a lot going on underneath the hood, if you will. So I'm going to take a few of the first few slides to discuss a little bit about, at a very high level, what the S&P 500 is, what the construction methodology is. Everyone knows and is familiar with the S&P 500, but what does it actually look like, quote unquote, underneath the hood from a concentration standpoint and the underlying companies that are driving these returns. So to start, you can see the S&P 500 here has generated strong returns. I'm sorry, Anthony, go back one. Has generated strong returns, not just last year, but really over the past 5 and 10 years. And has been some of the strongest returns on that page relative to global equities, to emerging market equities or developed market equities. No matter the time frame, the S&P 500 has been the best performing equity asset class for a number of years. And so why has that been? But to take it to a bit of a higher level, if we go to the next page and start with what is the S&P 500? If you look at the definition according to Wikipedia, we're all familiar with the name, but it's actually the S&P is a stock market index that tracks the performance of the 500 largest companies listed on the stock exchanges in the US. And so that begs the question, what is the definition of largest companies as measured by the S&P 500? So you can see when you think about largest companies, the S&P is looking at a term called market capitalization. And so all of the stocks are weighted in the S&P 500 based on how large they are. So the larger the stock is, the higher the weight in the index. And that measure, market capitalization, is just simply the price per share of a stock multiplied by the total number of shares that company has outstanding in the marketplace. So market capitalization changes every single day, and the biggest determinant of that change in the market is the price that a particular stock has in any particular day. So advancing to the next slide, what determines price? Because price is set by the market, but the two biggest determinants of what sets the price of an individual stock are either earnings or valuation, or something called the price earnings ratio. Earnings are easy. Every quarter, a company will announce what they've earned for that particular quarter. So earnings per share are valuable, and the more a company makes in earnings, theoretically, the higher the stock will go. But something that is a little bit again under the hood is the valuation, or the price that the market's willing to pay for the earnings of a particular company. And so to demonstrate that with an example, the PE ratio, by definition, just represents the price per share of a company divided by the earnings per share of a company. So theoretically, if you had two stocks, stock A and stock B, and both of them earned $10 a share, so they both earned the same amount of money, but one stock was selling for $100 and the second stock was selling for $200, then stock A doesn't have as large of a price as stock B. So the market's willing to pay a higher price for stock B's $10 worth of earnings and thus awards it a higher valuation. So stock B is its price in the market is double the price of stock A, and that could be for any number of reasons. The market believes that stock B's earnings will grow faster in the future, and it's all about looking forward as opposed to looking backwards. But be that as it may, with this as an example, the market's much more excited about stock B from a valuation standpoint and is willing to bid up the price of stock B by $100 relative to stock A for the same level of earnings. So what we've talked about is the price and valuation that largely determines how stocks are valued in the marketplace. So with that as a bit of a primer, let's focus now on the S&P 500 and the companies that make up the S&P 500. And here, I'd like to introduce a term that has become very popular over the course of the past couple of years. Some of you may be familiar with it. If not, we'll certainly give you a little bit more insight into the Magnificent Seven. The Magnificent Seven is referred to as the largest 7 stocks in the S&P 500 today: Apple, Microsoft, Google, Amazon, NVIDIA, Meta Platforms, which is Facebook, and then lastly, Tesla. These companies have been the stock market darlings of the past several years, and today represent the largest stocks in the S&P 500. So you can see at the high end, Apple and Microsoft are the 2 largest companies in the S&P 500 at a 7% weight. That weight, as we just learned, is determined by the market capitalization of the companies. So these are the 2 companies with the largest market capitalization in the S&P 500, with that market capitalization being driven largely by price, by historical performance. These weights fluctuate over time. So this example is as of December 31st, 2023. So at the end of the year, the S&P 500 had about 7% invested in Apple, about 7% invested in Microsoft, and you can see working the way down all the way to the 10th largest stock in the index, which is a company called Broadcom, at 1.2%. These Magnificent Seven in combination represent about 28% of the S&P 500. These Magnificent Seven stocks have largely driven a lot of the returns, a lot of those strong returns that we talked about on the first slide in the market, and we'll build on this in the slides that follow. But today we're at pretty much all-time highs from a concentration standpoint that these 7 stocks are representing of the overall market. We have some slides to represent that. One of the concepts I mentioned earlier, though, is that these weights fluctuate, and they fluctuate every single day based on how companies are doing in the market. So thinking about the S&P 500 today, and thinking about it a bit differently, to say if you were to invest $10,000 into the S&P 500, at the end of the year, what are you getting for that $10,000 investment? And so you can see that $10,000 buys you about $700 worth of Apple. That's the 7% weight that we were showing on the prior slide. It's buying you about $700 worth of Microsoft, the second largest stock in the index. Again, another 7% weight. And then you can see going down the Google, Amazon, Nvidia, Meta, and Tesla, all getting anywhere between $170 and $380 with that $10,000 investment. So those are the largest companies as measured by the S&P 500 in the index, the ones that are most valuable. But the S&P 500 index is made up of a number of large companies, ones that we're all very, very familiar with, that just so happen not to be as highly valued as those top 10. The likes of Home Depot, Starbucks, and FedEx, just to name a few, are companies we're all very familiar with, companies we probably use on a daily basis in our everyday lives. They make up the remaining, if you will, 493 stocks in the S&P 500. So you can see that $10,000 investment is made up of about 72% in all the other large stocks in the S&P 500 and 28% by those magnificent seven, if you will, those seven largest companies. I mentioned earlier that these weights fluctuate. So if we were to look back at what a $10,000 investment in the S&P 500 would have looked like 5 years ago, you can see many of the same names that exist today, but some different ones as well. So as I said, weights fluctuate, the largest stocks in the index fluctuate, but looking back just 5 years ago at the end of 2018, and if you were to have invested $10,000 in the S&P 500 back then, you can see that the same two large companies existed at the top of the index, Microsoft and Apple, but their weights were much less than where they are today. So 5 years ago, the largest stock in the index, if you were to invest $10,000, would have been Microsoft, and you would have got $372 worth of Microsoft stock and $338 worth of Amazon stock. So you can see that the top seven names back at the end of 2018 represented just 17% of the S&P 500. The remaining 83% investment would have been largely the same names that exist today in the index. You have Home Depot there at a slightly higher value 5 years ago than where it is today. Starbucks and FedEx, the same. They're still in the index. They were at a little bit of a higher weight. But given the performance of the Magnificent Seven over the past 5 years, and you can see that graphically here, that weight has grown from what was 17% for the largest stocks at the end of 2018 to 28% today. So that's what we're saying when there's a lot going on underneath the hood. We're really talking about how the characteristics of the index, the makeup of the index, the contributors to performance in the index change over time. And so you can see today, much more concentration, much more focus, 28 cents of every dollar is going into those largest stocks. Thinking about it differently, focusing on the index today, at a 7% weight in the index, 7% of the return of the S&P 500 is generated by how Apple did on any particular time period, a day, a quarter, or a year. Another 7% of the return is generated or contributed by Microsoft, whereas FedEx, an equally large company, is only contributing a small percentage of the return of the underlying index. So the larger that these Magnificent Seven become within the index, and the more concentrated the index is, and the more reliant the performance of the S&P 500 is on these larger names. Advancing to the next slide, Anthony, if you will, this exhibit goes back several decades to the beginning of 1990. And the blue line represents what we just talked about over the past 5 years, but going back to 1990, and it's representing how the largest stocks in an index have changed or how concentrated the index is today. So you can see at the beginning of this period, in this instance, we're looking at the Russell 1000 index, which is very, very similar, all the same construction methodologies that we talked about earlier. We sourced this slide from one of our investment managers, and they happen to focus on this particular index, but everything that we've said so far applies to this as well. But those largest stocks were under 20% of the index back in 1990, about 18% of the index back then. Today, again, close to 28%. So the level of concentration that we're at today is at historical levels. The market has never been as concentrated in recent history as it is on performance for those large stocks. The gray bar in this line is not as important for this discussion, but just to finish out the slide, that represents the contribution of earnings of those same 10 stocks that make up the weighting. So you can see a little bit of a difference today between the blue line and the gray line, which basically indicates that the market is paying a higher price, a higher valuation level for those stocks, those large stocks today, compared to where they have been in the past. And we'll talk about that in a little bit. Next slide, Anthony. So you may be asking yourself, why is that the case? Part of the reason, we think a big part of the reason as to why the market's more concentrated today is the growth of passive investments or passive mutual funds. Today, anyone can invest in any index through either a Vanguard product or an ETF, an exchange traded fund. And historically, the market's been made up very, very long term of active managers who are actively trying to beat the market through a number of different strategies, stock selection being one of them. The approach of passive investing or replicating an index has grown in popularity for a number of reasons. And so this chart looks back over the past 10 years at the growth of passive mutual funds relative to money that's being managed actively or through managers that are trying to beat the market. Why we think this is important and one of the contributors to concentration in the market is because every dollar that gets put into the S&P 500 today is buying more and more of the stocks that have done well. We saw in that example a few slides ago, whereas 5 years ago, you were buying Apple at just 3.5% of the S&P 500. Today, you're buying Apple at 7%. So the growth of passive contributes to some of these concentration issues because the way that the index is constructed, it's rewarding the companies that have performed best. Naturally, Apple and Microsoft have performed better than other companies over the past 5 years. So their weight has roughly doubled in the index. Part of that is because, as you can see on this slide, more money is being invested with that methodology in mind, as opposed to active managers who perhaps might own stocks in a different weighting than the S&P 500, might own stocks that are not included in the S&P 500. So we think this is a trend that's not going away and is partly responsible for some of the concentration levels that exist in the market today. Next slide, Anthony. So specifically looking at market performance in 2023, this slide, the dark blue line represents the performance, the cumulative performance of the Magnificent Seven throughout 2023, with the lighter blue line representing all of the other stocks outside of the seven in the index. So in this instance, it's looking at the Russell 1000. So the remaining 993 stocks represents the performance of the light blue line, and the dark blue line certainly represents the performance of those large Magnificent Seven stocks. And so you can see, for the year, for 2023, the Magnificent Seven returned about 80% as a basket of companies, whereas the remaining 993 names in the index returned about 15%. So thinking about that from an index contribution to return standpoint, for 2023, well over half of the return of the index. So thinking about that 26% return of the S&P 500 earlier on, well over half of that return was generated by just 7 stocks. And so, as you can see here, the remaining stocks, 993 in this case, also had a good year at returning 15.5% over very long periods of time. 15% return in the S&P 500 is well above normal, but it was hard to compete with the truly historic returns of the Magnificent Seven at over 80%. So again, one of the big stories from an index perspective, why the indexes have done so well, is because those largest stocks, because the market's very excited, let's face it, about the earnings potential of AI and technology and the internet, and all of those aspects really went into why the Magnificent Seven performed as well as it did at close to 80% and represented well over half of the return of the index. Next slide, Anthony. And to explain this back from a valuation standpoint, and here we're really getting into underneath the hood, what does the market look like from an opportunity standpoint. Again, the blue line represents the largest stocks in the index, but not looking at performance, looking at valuation, looking at how expensive the market is treating, or how expensive these stocks are trading relative to the earnings that they're generating. The light blue chart line here on this chart, again, is the remaining stocks, the remaining 990 stocks within the Russell 1000 index. And so you can see that from a valuation standpoint, that dark blue line has been pretty far upward sloping to the right, really over the past 5, 6, 7 years. The valuations of those stocks are expanding much more than their earnings. Clearly, they have generated strong earnings, but the price that the market's willing to pay for these companies has steadily increased as well. When you compare that to the remainers, the companies that are perhaps not at the forefront of all of the headlines and enthusiasm, you can see that that line is diverging and has actually gone down over the past 5 or 6 years. So the market is not as excited about the growth or the earnings of the remainers. And part of the reason why these Magnificent Seven stocks have performed so well is because their valuations have expanded much quicker than the rest of the market. The table at the bottom of this chart puts some numbers to that, and you can see just comparing year-end 22 to year-end 23 on the left-hand table, the top 10 stocks traded at 19 times earnings at the end of 22 and traded for 28 times earnings at the end of 23, compared to the rest of the market, which basically didn't see much in the way of valuation expansion last year, with the S&P up, or the S&P or the PE the end of 22 at 16 versus 17. The right-hand chart table attempts to put this into percentiles to history to say, okay, relative to the rest of the stocks in the index, how cheap or expensive are these segments of the market? And so today, you can see at the end of 2023, it's very hard to find time periods where the top 10 stocks have been valued as high as they have been. It's ranking in the 93rd percentile, meaning there's only 7 percentile of observations out there where those stocks are more expensive than they are today. And importantly, the remaining stocks, all of the other stocks that have somewhat been left behind over the past several years, there isn't too many observations out there where they've been cheaper relative to the rest of the market. So that 2 percentile representation for the remaining stocks in the index represents pretty historic cheapness from a valuation standpoint. So if anyone likes to shop at Walmart and likes to pay less than market price, well, sort of that's what's going on underneath the hood, if you will, that the remaining stocks in the indexes are selling for very, very attractive long-term prices. Next slide, Anthony. this is a different measure of what I just talked about, but we're all familiar with small cap stocks, stocks that are smaller in market capitalization than large cap stocks. And you can see after a number of years of underperformance relative to large cap, down below, you can see how our portfolio, our global equity fund, is positioned. And so building on that that measure that I just talked about earlier, that the stocks underneath the Magnificent Seven are historically cheap, our managers, where we employ active managers in our portfolio, have tending to be leaning into the cheapness of those names. And so the pie chart on the left-hand side, you can see 12% of our portfolio in mid-cap or companies not as large as the large cap stocks, and 2% in smaller cap stocks, really being driven by the underlying valuation opportunity that exists there. When you compare that positioning relative to our benchmark, the MSCI ACWI Index, which is a global benchmark, it's looking at the global opportunity set, not just the US, but the rest of the world, including Europe, Asia, the emerging markets. You can see that it's mostly comprised of large cap stocks. And so our portfolios are a little bit more exposed to mid and small cap stocks because of the valuation opportunity that's existing there as that valuation has become stretched for the Magnificent Seven and the larger cap stocks. Advance to the next slide, please, Anthony. So this concentration level, let's expand this out to talk about global markets, is really just a phenomena in the US. So the dark blue line here represents the concentration level, the weight of the top 7 stocks in the US. The light blue line represents the rest of the world, in this instance as measured by a developed international index. And so you can see that the US market is much more concentrated than the rest of the world. Those 7 stocks represent just 10% of the construction of the developed international markets. Again, much more concentrated levels in the US because, as we all know, only in the US can you invest in world-class technology companies like Apple, NVIDIA, Google, Amazon, Facebook. These companies have been rewarded for their strong growth profiles, and they happen to reside in the US, and so that's where most of the concentration exists. And to kind of complete that thought, if we look at the construction of the MSCI ACWI Index, which again is a global benchmark, those same Magnificent Seven stocks are represented in the ACWI benchmark as well, because it includes the US, and that concentration level of the Magnificent Seven, of those stocks, is larger than the exposure that you're getting from single countries. The entire stock market of Japan, the UK, and Canada, and Switzerland, and some of France, when you factor in the weightings of those countries in relation to the Magnificent Seven, you can buy the entire market in Japan, or you can invest in Apple. So Apple's just under 5% of the ACWI benchmark, and Japan is about 5% of the ACWI benchmark. Now, the Japan stock market and ACWI includes about 800 different securities, and so this is just a different way of measuring the concentration, if you will. Apple is the largest company in the world from a market capitalization standpoint. In fact, in this instance, it's larger than the entire Japanese stock market. We think that there's some discrepancies, obviously, in valuations that exist there, and many managers are very excited about the prospects that are going on in Japan. But this is just another measure of how outsized these concentration levels are relative. Earlier, we were talking about relative to other stocks. Here, we're talking about relative to other countries. So the concentration levels obviously exist. They morph over time, and so we think there potentially could be opportunities in non-U.S. markets. So our global equity fund, our managers in our global equity fund are slightly tilted more towards the opportunities in the non-U.S. markets, again, because of the valuation opportunity that exists relative to how these 7 stocks are contributing to the valuation picture in the U.S. And then lastly, from a style standpoint or a performance standpoint, something we measure in the domestic U.S. market is how market cap weighting performs relative to another passive construction methodology, which is basically equal weighted. So you can invest in the S&P 500. Most people think of the S&P 500 that we just talked about, which is the market cap weighted version. That's industry standard. That's what gets quoted on the on CNBC or anytime you track the performance of a mutual fund. You can also invest in an equal weighted version of that, which basically takes out all of the first couple slides we talked about, which looked at the market capitalization and the concentration to determine how stocks are weighted in the index. In an equal weighted concept, it is exactly as it sounds. All 500 stocks in the S&P 500 are equally weighted. And so you can see over time, the characteristics, all of these things ultimately are a cycle. Right now, we're in a cycle that favors market cap weightings over very long periods of time. As you can see, equal weighting has been a better way to invest in the market. The prospects of diversification and diversifying your eggs across 500 stocks as opposed to the concentrated nature of market capitalization tends to work over long periods of time. But we're at a point in time today, again, cyclically, that has favored market cap. And so we're aware of that in the portfolios. Our managers, our active managers are aware of that and tend to run a bit more diversified portfolios with the expectation that things will cycle through and favor equal weighting at some point in the future. So hopefully that was an interesting look, again, underneath the hood of all that goes on in something that we hear quoted. We're familiar with the S&P 500, but really the makeup, the construction methodology, the devil's in the details, as they say. And so understanding how benchmarks are constructed and how those construction methodologies really do drive performance and cycles is an important aspect of understanding not just what's happened in the past, but potentially or importantly, what will happen in the future. So we've left a couple minutes for questions if there happen to be any. We're certainly more than happy to take those questions now. Kelso, I don't know if you've been monitoring that.
Yeah, I haven't seen any yet, Mark. Maybe we'll take the screen down and open it up and pass it back to Meredith and her colleagues.
Okay, I'm not seeing any questions come up yet, so I just want to take a moment to thank you, Mark, for an excellent presentation. I think it was interesting to see the impacts of the Magnificent Seven, not only on the market over time, but also globally as well. I'd also like to thank everyone for joining us today virtually. Hopefully next year the snow will not get in our way and we'll be able to see one another in person. We also thank you for choosing YCCF as your partner in endowment and hope you all have a great afternoon.
Thank you all.
Thanks, everybody.